Alright guys, so today's video is going to be a little bit different to normal, so I just wanted to take a quick moment to explain the context of what you're about to see. So basically, last Wednesday at 6 o'clock UK time, we held our first ever live webinar for course members. So this is something we're going to be doing more regularly, like every couple of weeks, and it basically gives me the chance to show my analysis live in the charts, to show things in a practical way, while also taking questions from the live chat. So I know what I need to go into more detail about, what other questions people have burning in their minds that I can answer for them, and it just makes the overall learning experience a lot more interactive. So last week was the first ever one, and I wanted to talk about how I use the different time frames to find a trade entry. And it just so happened during that 1 hour slot that we found a trade opportunity to go long with Euro Japanese yen. So rather than that lesson being lost once the webinar ended, I wanted to take the clip of me using the different time frames to find that entry and just put it on here for you all to see, because I think it was a really good example of that in action. Because sometimes, like certain concepts with trading, it's very difficult to explain it in a theoretical point of view, and much easier if you see a practical example of it. However, it's not always that when you go to the charts that you get a clear example of it. So since we had such a clear example this time, I wanted to show you. You have to bear in mind it's a recording of a webinar. So unfortunately, the audio, the video is not the best quality. It's a recording of something that was live broadcast across the internet. So you have to kind of struggle at times to hear what I'm saying, but the main points of the lesson are there and they're very clear for you to hear. It may be frustrating at times with some lag, but please bear in mind it was just a live recording. But still, I hope that you find it useful, and I'll fill you in at the end about what happened next. So if we open up Euro Japanese yen, this is the same chart that we used in our technical analysis on Sunday. And you can see the situation right now is that we had this sort of spike out of the range that I was complaining about on Sunday. I liked this currency pair for a long time because it was ranging around here. Before that, it was ranging around here. If we go back further, it was ranging. And we had this nice little range that we were all benefiting from, and it broke out. And the candles have got bigger, and it seems like, sort of volatility in the markets come back, or at least the movements have become a little bit more obvious, let's say. So it's getting more structure, which is one thing that we look for, that's good. But on the other hand, it's ruined this sort of tight trading that we had for a while. Having said that, we have a situation now where obviously it's approached this baseline trend line, and it's also sort of re-entering this range that we had before. So I'm going to switch back to the other charts that we had going on over here, and let's just zoom in. So we have this it's like a short-term baseline trend line. Obviously, if you're going back long-term, then I'll be zooming out and looking, at this is one baseline trend line, or trying to factor in this wave. But essentially, we're looking at this area up here. Now, this top section, you can see we had this sort of reversal zone before, and we broke through and we're on the other side of it, so the colors would be the other way around now to show the strength. This top section could potentially be a reversal zone, but the difference between this one and this one down here, the difference between the one that we're in right now and the one that we were in at the bottom of that range, is the way that the price moves. So with a reversal zone, I always like to see it as an area on the chart where the price is actually behaving differently. So it's one thing to have a significant level there, and it's another thing altogether to have a whole area on the chart where the price behaves differently. So what I mean by that is when the price enters that range, that zone, whatever you want to call it, it's getting more erratic, it's getting pushed straight out, and so on. So it's not, I know a lot of people look back on their chart and draw out the reversal zone by looking at how many reversals happens in that area, and to a certain extent that's what I do as well. But when you come in to trade it, you need to really be observing, is the price actually behaving differently here? And that's how you can tell whether it's actually going to be a reversal zone for you or not. Because essentially with a reversal zone, what we're saying is that when it comes into this zone, it doesn't need to be at the top or the bottom like other significant levels. It just needs to be inside it for that to be a double confirmation. And you can see if this was a reversal zone around here, let's say that we drew it from this point over to here. I'm taking this candle body over here. I hope you can see that. Let me know if you can see, if you want me to zoom in or anything, I can. If we're taking like from this candle body to these ones up here, we're basically inside that now, and we'd be saying that we should be seeing that price behaving differently there. So if we drop down in time frame, we should be able to see that price behaves differently in that area. You can see it does a little bit, it's got rejected straight out there, but in general, it seems pretty standard. So I'm not going to be using it as a reversal zone just yet. I'm going to be sticking to it as just a swing high there. So that leaves us with a situation where we have this trend line and we have this swing high over here. Now the time right now is 20 past 6, which means that in a few hours time, this daily candle is going to close. We know that significant levels attract and repel the price. So when it starts coming so close to the end of the candle like this, I start thinking that it's probably going to want to be attracted back to that level. When it's such a long move, relatively speaking, looking at the previous candles, such a long move that's gone through the trend line like that, I think that since it's struggling with the price around here, it's most likely going to want to close up there. So already that presents us a little opportunity, not to trade based on this, but in terms of what we're looking for. So where the price is right now compared to where it could close, it's only like 20 pips. But talking about this time of day, that's quite a lot really. So at this stage, what I would be doing is dropping down in time frame in order to find if there's a situation where I could take a long trade. I wouldn't be looking for a short trade, because a short trade would be expecting that it's going to break out of here, and therefore you'd be expecting there's going to be a lot of momentum pushing through this level. We can see that throughout the day we've had a lot of momentum already pushing towards this level. So what are the chances that we're going to have enough momentum that this is going to be a ridiculously big bearish day in the last few hours of this day, when the European markets aren't open and neither are the Japanese markets, and it's obviously Euro-Japanese yen. So we're looking at small movements around this time of day. Going to drop down to hourly. Now we had an interesting situation here. I was looking at it just before the webinar and I was like, please don't approach the level until we do the webinar. But it approached the level and it already had the reaction. Basically, it was this range over here. Now, so when we draw out the Fibonacci ranges, we look for the most obvious ones, and this isn't necessarily the most obvious one, but it has got one benefit, which is that it's the most recent one. So you look for the most obvious ranges, and when you have some obvious ranges, you go for the most recent one of those obvious ranges, and then you can map out the other ranges as well and get confluence. What I mean by that is that this is the most recent one, and you can see the levels there. If you had other ranges back here, you could also start to map those out and see where there's levels, where there's confluence. But in this case, this was such a big move down, we're not going to approach those levels tonight. I haven't mapped out this range yet. So you can see this is a confirmed range, and we're struggling with exiting that range at the moment. That was the bottom of the range, that's a significant level, and those are the extension levels down here. About a few hours ago, 2 or 3 hours ago, I think it was 3 hours ago, we had this situation. We had this Fibonacci range here. You can see it's confirmed, the C point. Let me zoom in so you can see it properly. The C point is confirmed at a 38.2, and that left us with minus 27.2 down here and a minus 61.8 down here. Now, I was praying that it wouldn't get to this level, the minus 27.2, because I was hoping we'd be able to pick something up there. It closed to the type 2, and you can see the reversal. Now, the positive thing for us right now is that it didn't re-enter the range, which means that this level down here, the minus 61.8, is still in play. So I don't want to trade based on the hourly chart, because there's not enough hours left in the day for us to really, have a whole wave completed if necessary. Remember, with your time frames, it's not just about using that time frame candle, but also about having the time horizon to be able to allow the waves to complete. And if we look at these waves here, we're talking, how many bars is this? From this point here across to here is 34 bars. That's 34 hours of trading there. If you wanted to wait for that amount of time for a wave to complete, it's not going to work out for us. Same if you wanted to go from that bottom of the wave to the top here, that's 17 bars, that's 17 hours. So trading an hourly chart is not a good idea for us now if we want to complete it in the webinar. So instead, I'm going to take this confirmed range, I'm going to move this down to the minus 61.8, and I'm going to move down in time frame to see if I can use what I understand is probably going to happen here. And what I think is probably going to happen here is that we're going to have some sort of reaction down here, and eventually there's a very good chance that it will want to return to that trend line. That's not a definite that it's going to happen. I think this trend line can be adjusted slightly, and we'll come on to that in a sec. But we've started to create a story of what we think is going to happen and what we're aiming for here. So let me just check that this is showing on other time frames. Okay, good. So what we're going to do is drop down to a time frame that is going to be our working time frame now. So in this situation, it's going to be either 5 or 15 minutes. Really, I think that you can use them both in exactly the same way. Like, I don't really have a preference between 5 and 15. The way that I decide which one to use is which one's showing me the most established waves. So this is what I always call the Goldilocks waves. I'm looking for the waves that are just right. The ones where it's not too messy, that, you can't figure out where the waves start and end, but not too not messy, not too like not such little amount of data that you actually can't see the waves being pronounced enough. Like here, it's quite good. You can see the waves there, but at the same time, you've kind of got this flat movement down here, this trend. And if we map that out, you have this trend where the top is pretty good. So adjust this slightly. I think it's more likely to be along here. So if we were trying to find something from the top, that's pretty good. But from the bottom, it's a little bit messy. It's a little bit difficult to find where you'd map that trend out. I'd probably go for micro trends, like looking down here. You can see that we've broken through it. So there's nothing really for us to use on the lower side. So in terms of the 15-minute, I'm not exactly ecstatic about it. So let me just see with this range here. This range is also confirmed, and you can see the minus 61.8 there is pretty much in confluence. So I'm going to map that one out. And just so we know it's different, I'm going to change the color of that. So I know that this is now the 15-minute. You see the price approaching it. This could get very interesting for us. So let's very quickly now, we know this area down here, I guess there's going to be some sort of news, how something's going on to make it go down. Anyway, so very quickly now, we've got a single confirmation on both timeframes if we have an interaction around here. It looks like prices wanted to push through that. So at this point now, I'm starting to look at my working time frame. What are the levels that I could be trading? So I'm looking at the most recent range first of all. That's confirmed there. You can see that we've kind of broke through the minus 61.8 before. We're pushing through it very heavily at the moment. We can look at the bigger waves as well to see if there's anything confirmed there. You can see that this one is also confirmed with the C point there. That's the same one we were getting on the 15-minute, but it means we can also trade it based on the 5-minute. And in terms of anything else going on here for double confirmation, I'm now like looking at what type of market we're seeing. So first things first, we've obviously been breaking out of ranges that we had before. So Fibonacci works for us. But in terms of trading the 5-minute, this is very different to trading the daily. In terms of the daily, you're in a sideways market. In terms of the 5-minute here, you're in a downtrend at the moment. So in this case, you want to be using some trend lines as well, or something that's going to help you out here. So in this case, I'm starting to look at where the trend started. This is my go-to. So I'm looking at, this is the first low, and we've had lower lows since then. So I can choose that as my first anchor point, choose this one down here and see how that works out. You can see that we've got a type 1 touching point down there at the moment. This would be unconfirmed, so it's not necessarily the best one for us to be using. But we can, because we've got so many other factors on the higher time frame in our favor, we can go for that if we wanted to. What's the time? 28. So we're running out of time here to do our analysis if it's going to be on this 5-minute candle. We also have other ranges going on, but you can see if you look like at this one, we've already broken through that. We don't have any other ranges going on right now. So in this situation, it looks like we're probably going to close as a double confirmation in about 2 minutes time, or a minute and a half. What's the seconds at the moment? In 1 minute's time, we're probably going to close as a double confirmation there. How lucky is that? In the first analysis we've done, we might have a live setup. Now, this is quite a weak setup from the point of view of the 5-minute chart. We've got an unconfirmed trend line, although if you look at this area around here, let me just draw it in. If you're looking at this area around here, which is the short term, then this sort of trend line along here could be the baseline trend line. For this move down, this is the baseline and it's struggling at it, so that's a good sign. If you were just trading the 5-minute on its own, you'd maybe not trust this. However, we've got other factors on our side. We know that, for example, we have the 15-minute on our side, we have the hourly, we have the daily. We know that it's got the double confirmation that because significant levels attract and repel the price. So this level is only meant to be appearing on the 5-minute. Since significant levels attract and repel the price, we know that it could be attracted up to there as well, so we can use that to our advantage. If we drop that down to the 5-minute, at this point, okay, it's a little bit late, but I would be entering a probe trade. So not a full trade, not a small trade, a probe trade. It would be a small trade anyway because we're going against the trend. So that would be 0.5 for my account in this situation. Because it's a probe trade, I would be going for a smaller amount of that and potentially scaling in to make it a full trade. My full trade is 0.5%. In this situation, that candle, although it looked very bearish, it was clearly struggling with these significant levels. So I'm probably looking at this being something like 0.3% of my account at risk at this point. In terms of stop loss, my stop loss would be just below this level down here, setup break. The reason is, if it's going to be traveling down there, since this is a downwards trend line, if it bounces along that trend line, I'm going to be just increasing my loss over time. So if it was an upwards trend line, I'd maybe have my stop loss based on the trend line being broken at the close of the candle, because you know that if it bounces along the trend line, you're only increasing your profit. If it's a downwards trend line, you're only increasing your loss. So I want to have my stop loss based on a setup break of this candle. I don't want to be relying on that trend line. So that means that in terms of risk, and I know that it's a little bit late because the candle's moving, but it's just because I was talking through the analysis. We're looking at a 9 pip, more or less, like let's say a 10 pip stop loss. And in terms of my target for this one, I'm going back to my daily chart here. It's not exactly correct to mix up the timeframes in this way, but because it's so clear, I'm going to be looking for it to be closing the day at this trend line. So we're looking from the point we're at now up to that trend line is about 37 pips. That's not the TMP, but that's, you know, like what I'm expecting for the trade. In terms of TMP, I'm looking at re-entering the Fibonacci range up here, which would be from that point of entry if we had entered. Well, it's actually a lot more. It's going to be 42 bits, which I would think is a bit too much. In the situation where you're expecting the movements are too small for it to reach the TMP, if the range has been going on for a very long time, and then the movements are very small at this point in time, then I prefer to use a significant level that's closer where it's likely to stall first. In this case, it's going to be there. So that's 21 pips. So it's pretty much a 2-to-1 trade, a little bit more than that. In terms of the initial risk reward on the TMP and the stop loss. But as I said, we are looking at potentially entering a bigger wave and then closing the day at that trend line. So at this point, I went on to explain about the exit criteria, how we go about trade management and a few other things and answering questions from people. But because the webinar was 1 hour long, I just wanted to make sure we have a short clip for this video just so you have the core lesson there. So let me now show you what happened a few bars later, like what would happen during that trade. That movement, by the way, if you're wondering, from the entry there to sort of where it is now is 24 pips, to the top there was 32 pips. Remember when we entered, we were sort of the TMP was based on 21 pips. So as you can see, the trade performed exactly as we expected. It ended up being pretty much a textbook trade of creating higher highs and higher lows on that time frame. But obviously we were aiming to be out of that trade before the end of that trading session. When you're entering trades, it's not always that you have to stick to exit criteria based on the trade itself. Preferably that's what you would do, but we have to be practical here. We're not always going to be staying up all night to monitor a trade. So if there's a good reason to be exiting it based on other factors, such as the need to go to sleep, then it's okay to be exiting the trade there. So we were targeting this trade to be closed before the end of the day, and it hit our TMP, it went further than that, it ended up being a very good trade. And so it was a very good situation to be in. It was a good example of how we use the time frames from the daily all the way down to 5 minutes to find that precise entry where it barely goes against us, doesn't come near our stop loss, and relieves us of a lot of stress. So guys, I hope you enjoyed it. I hope that you sort of survived the bad audio there and the bad video and you still picked up the lesson. In future, when we do these webinars, I will try to get a better recording as well. But at this point, I didn't expect to be putting this one on the YouTube channel. It was only going to be for our course members, but I just wanted to make sure this lesson wasn't lost because it was such a good example. So guys, thanks a lot for watching. If you like this video, please do hit the thumbs up. Don't forget to subscribe to the channel so you don't miss out on any more of our videos about trading and the financial markets in general. If you've got any questions, comments, leave them below. Take care, and I'll see you soon.